Welcome back to the trading floor. I'm David Axtell. We've covered the foundations, market structure in episode 2, participants and their motivations in episode 3. Today, we're getting practical. We're talking about how to actually read a foreign exchange quote, what the numbers mean, how to avoid the mistakes that cost people money. This sounds basic, and in one sense, it is. But I've seen experienced finance professionals misread FX screens because they didn't understand the conventions. I've seen people execute trades in the wrong direction because they confused which currency was which. These aren't rare mistakes. They happen more than you'd think. So we're going to walk through quotation mechanics step by step. Base currency versus quote currency. Pips, bid, and offer. Big figures. By the end of this episode, you'll be able to look at any FX quote and immediately understand what you're seeing. Let's start with the most fundamental concept. Every currency pair has two parts. When you see Euro-US dollar equals 1.0850, you're looking at two currencies. The first currency, the euro, is called the base currency. The second currency, the US dollar, is called the quote currency. The exchange rate tells you how many units of the quote currency you need to buy 1 unit of the base currency. So euro dollar at 1.0850 means 1 euro costs you 1.0850 US dollars. If you're buying the pair, you're buying the base currency and selling the quote currency. If you're selling the pair, you're selling the base currency and buying the quote currency. This matters because getting it backwards changes your entire exposure. If you think euro dollar is going up, and you sell instead of buy, you've just taken the opposite position to what you intended. Now here's where it gets slightly complicated. The market doesn't follow alphabetical order for which currency comes first. It follows conventions that developed historically. The euro is always base against everything else. So you'll see euro dollar, euro sterling, euro yen, never dollar euro. Sterling, the British pound, is usually base. We call pound-dollar cable. That's market slang. The name comes from the transatlantic telegraph cable laid in 1858 that connected London and New York. It was the first cable that allowed foreign exchange prices to be transmitted between the two financial centres. So traders started calling the pound-dollar exchange rate the cable rate. Eventually, it just became cable. So when someone on the trading floor says cable's at 30, they mean pound dollar is at 1.30 something, usually 1.3050 or 1.3048, depending on bid or offer. The Australian dollar and New Zealand dollar are usually base against the US dollar. Aussie dollar, Kiwi dollar, these are the market names. In Wellington or Sydney, they might say the Kiwi or the Aussie, and everyone knows what they mean. But then you have pairs where the dollar is the base currency. Dollar yen, that's US dollar against Japanese yen. Dollar Swiss, that's US dollar against Swiss franc. Dollar CAD, US dollar against Canadian dollar. You need to memorize these conventions. There's no logic to it. It's just how the market developed over decades of trading. And professional traders will look at you strangely if you say dollar euro instead of euro dollar. Now let's talk about pips. The word is spelled P-I-P. Nobody really uses the full term anymore, but it originally stood for percentage in point. It's just called pip. A pip is the standard unit for measuring price changes and spread costs in FX. For most currency pairs, 1 pip equals 0.0001. That's 4 decimal places. So if euro dollar moves from 1.0850 to 1.0851, that's a 1 pip move. From 1.0850 to 1.0860, that's 10 pips. But here's where you need to pay attention. Japanese yen pairs are different. Because the yen trades at much lower nominal values, yen pairs only go to 2 decimal places. So 1 pip in dollar yen equals 0.01. If dollar yen moves from 145.25 to 145.26, that's a 1 pip move. From 145.25 to 146.25, that's 100 pips. This difference matters when you're calculating position sizes and profit and loss. A 1 pip move in euro-dollar on a 100,000 euro position is worth 10 US dollars. But a 1 pip move in dollar-yen on a $100,000 position is worth about 900 yen. Different calculation entirely. Modern platforms also show fractional pips. That's a fifth decimal place for standard pairs, 0.00001, or a third decimal place for yen pairs. You'll see quotes like euro-dollar 1.08503. That final 3 is a fractional pip. It allows for tighter spreads, especially in electronic trading. But when professionals talk about price moves, they still usually reference full pips. Now we need to talk about bid and offer. Because when you look at a quote, you're not seeing one price, you're seeing two. Let's say you're looking at euro-dollar and you see 1.0850/1.0852. That's bid 1.0850, offer 1.0852. The bid is where the dealer will buy the base currency from you. The offer, sometimes called the ask, is where the dealer will sell the base currency to you. This is always quoted from the dealer's perspective. They're saying, I will buy euros at 1.0850, I will sell euros at 1.0852. Which means, from your perspective, if you want to buy euros, you pay 1.0852. If you want to sell euros, you receive 1.0850. The difference between bid and offer is the spread. In this case, 2 pips. That's your transaction cost. You always trade at the price less favorable to you. You buy at the higher price, you sell at the lower price. The dealer profits by doing the opposite. They buy at the lower price, sell at the higher price. Spread sizes vary dramatically depending on the currency pair, time of day, market conditions, and trade size. Major pairs like euro-dollar might trade at half pip spreads during liquid hours. Emerging market pairs might have spreads of 10, 20, even 50 pips. Understanding spreads matters because they're your primary cost. If you're trading frequently or in size, those pips add up quickly. A strategy that looks profitable, ignoring spreads, might lose money once you factor in execution costs. Now let's talk about something that confuses people initially, but becomes second nature with practice. Big figures and abbreviated quotations. The big figure refers to the first 3 digits of a currency pair. For euro-dollar at 1.0850, the big figure is 1.08, or just 108 in market speak. The last 2 digits, the 50 in this case, are the pips, and they're what changes constantly as the market moves. When dealers are quoting prices quickly, especially on voice or chat, they'll often only quote the pips. They'll say 50/52 instead of the full 1.0850/1.0852. This works fine as long as everyone knows what big figure you're in, but it creates potential for confusion when prices are transitioning across big figures. Let's say euro-dollar has been trading around 1.0850. A dealer quotes 98/00. What does that mean? Context tells you this is 1.0898 bid, 1.0900 offer. The offer has crossed into the next big figure, 1.09. The economic logic reinforces this. A 2 pip spread makes sense. A 100 pip decline in the bid price makes no sense unless something catastrophic happened. But I've seen people misinterpret this, especially newer traders who don't yet have that instinct for what makes sense and what doesn't. Modern electronic platforms usually show full prices, which eliminates this particular confusion. But if you're working with dealers on chat or voice, understanding abbreviated quotations is essential. Dollar-yen uses the same convention, but with different precision. At 145.25, the big figure is 145. A dealer might quote 25/27. But because yen pairs use 2 decimals, transitioning from one big figure to the next represents a larger move. 145 to 146 is 100 pips, not 70 or 80 like it would be in a 4-decimal pair. Let me give you a practical example of how these conventions matter. I once had a client, a corporate treasurer, who wanted to hedge euro receivables. They had euros coming in and wanted to convert to dollars. They called and said they wanted to buy euro-dollar forwards. That would have been the wrong trade. If you're receiving euros and want dollars, you're selling euros, not buying them. You need to sell euro-dollar, not buy it. We caught it before execution. But if they'd done that trade on an electronic platform without speaking to someone first, they would have doubled their exposure instead of hedging it. This is why understanding which currency is base and which is quote matters. It determines which direction you need to trade. Another common mistake involves confusing the currency amount with the direction. Let's say you have a dollar-yen position and you want to close it. You need to trade the same amount in the opposite direction. If you're long $100,000 yen, meaning you bought dollars against yen, you close by selling $100,000 yen. Same amount, opposite direction. But I've seen people try to close by trading the yen amount instead of the dollar amount, which creates a mismatch and doesn't properly close the position. The base currency determines your position size, always. In euro dollar, if you're long 100,000, that's 100,000 euros, not dollars. In dollar yen, if you're long 100,000, that's $100,000, not yen. Now, let me address something that confuses people who are new to FX but have experience in other markets. Stock traders, for example. In stocks, if you buy, the price you pay is the ask. If you sell, the price you receive is the bid, same as FX. But in stocks, you're always thinking in terms of one currency, how many dollars to buy one share. In FX, you're simultaneously long one currency and short another. When you buy euro-dollar, you're long euros and short dollars. When you sell, you're short euros and long dollars. This means your profit and loss depends on both currencies. If euro-dollar goes up, euro appreciation helped you, but dollar depreciation also helped you. You're benefiting from the relative movement between the two. Understanding this two-sided nature of FX is critical for proper position management and risk assessment. You're not just speculating on one currency, you're speculating on the relationship between two. Let me finish with the most practical advice I can give you about reading FX quotes. Always verify your understanding before you execute. Ask yourself, which currency am I buying? Which am I selling? What's my exposure if the rate moves one way or the other? Does this trade do what I think it does? It sounds obvious, but mistakes happen because people assume they understand when they don't. They see numbers on a screen and think it's straightforward. Then they execute and realize they got the direction wrong or misread the quote. I've been trading FX for 35 years. I still pause and verify when I'm dealing with a currency pair I don't trade frequently. It's not because I don't know the conventions. It's because I know how costly mistakes can be. That's how you read an FX screen. Base and quote currencies. Pips, bid and offer. Big figures and abbreviated quotations. Market names like cable for pound dollar, Aussie for the Australian dollar, Kiwi for the New Zealand dollar. And most importantly, always verifying your understanding before you trade. We've now completed part 1 of the trading floor. We covered market structure, participants, and quotation conventions, the foundations you need to understand everything that follows. Next episode, we move into part 2, Spot FX trading, the mechanics of how transactions actually work, T+2 settlement, value dates, how spot rates are determined, what happens between the time you agree to a trade and the time money moves. That's where FX gets interesting, because spot looks simple on the surface. You agree on a rate, you exchange currencies 2 business days later, but there's more complexity than most people realize. And understanding that complexity matters for risk management, execution, and operational efficiency. I'm David Axtell. Thanks for joining me on the trading floor. If you're finding this series useful, subscribe wherever you get your podcasts. And if you want the comprehensive treatment, FX Cash Products, the book Luigi Rondinini and I wrote, covers all of this in depth. Available through Rondinini Publishing. See you in episode 5.